Your grandmother turns 65, gets her Medicare card in the mail, and suddenly everyone's congratulating her like she just won the lottery. Your uncle retires at 62, starts collecting Social Security, posts about it on Facebook with a beach photo. Your neighbor qualifies for senior property tax exemption, saves $800 a year, tells everyone at the grocery store. Here's what nobody tells them. That Medicare card comes with a premium that goes up every single year based on your income from 2 years ago. That Social Security check your uncle's getting, he locked in a permanently reduced benefit because he claimed early, and if he ever goes back to work before his full retirement age, the government claws back $1 for every 2 he earns above $16,000. That property tax exemption, it's funded by raising taxes on everyone else, which means your kids are paying more, so your neighbor can pay less, and the total tax revenue stays exactly the same. So here's my question. When the government gives you 28 different benefits specifically because you hit a certain age, are you actually getting richer, or are you just getting a different set of handcuffs? I'm going to explain how senior benefits actually work in 2026, why most of them are designed to keep you poor, and the 3 that actually matter if you're trying to build wealth in your 60s instead of just managing decline. Because here's the thing, I've spent 10 years running my own business, surrounded by people who read tax code for fun. And I've got multiple hundreds of thousands of dollars in markets, watching how the system actually moves money. And what I've learned is this. Most senior benefits aren't gifts, they're incentive traps. Think of the senior benefit system like a hotel loyalty program. Stay with us, we'll give you free breakfast. Sounds great. Until you realize the free breakfast is 2 stale muffins and burnt coffee, and you're locked into booking only their hotels, which are 20% more expensive than the competition. You're getting something, sure, but you're giving up optionality. You're surrendering flexibility. And in personal finance, optionality is worth more than almost anything else. So let me give you the framework I use. Senior benefits fall into 3 buckets. First bucket, income replacement. This is Social Security, pensions, that kind of thing. The government or your former employer sends you a check every month. Second bucket, cost reduction. Property tax breaks, Medicare, prescription drug discounts, things that lower your expenses. Third bucket, tax optimization. This is 401k required minimum distributions, Roth conversions, capital gain strategies, the stuff that determines how much of your money you actually keep versus how much goes to the IRS. Now you might be thinking, okay, these all sound good. What's the problem? The problem is the incentive structure. Each bucket is designed to solve a different problem, but they all share one hidden feature. They assume you're broke. They assume you have no other income. They assume you're living month to month on a fixed budget. And the moment you're not broke, the moment you actually have assets, the system starts punishing you. Let me show you what I mean. Here's escalation number 1. Social Security. Everyone knows about it. You pay in your whole working life, you collect when you retire. Sounds fair. The average Social Security check in 2026 is about $1,900 a month, $22,800 a year. Now here's what they don't tell you. If you're married and your combined income exceeds $32,000, up to 85% of your Social Security becomes taxable. Think about that math. You paid Social Security taxes your whole career on money that was already taxed. Then when you collect it, if you have any other income, a part-time job, some dividend income, rental property, the government taxes up to 85% of your benefit again. You're being taxed twice on the same money. But wait, there's more. If you claim Social Security before your full retirement age, which is now 67 for most people, and you earn more than $21,240 from work, the Social Security Administration reduces your benefit by $1 for every $2 you earn above that threshold. So let's say you're 63, you claimed early, you're getting $1,600 a month, and you decide to take a part-time consulting gig that pays $40,000 a year. You're $18,760 over the limit. The government takes back $9,380 of your Social Security. You just lost more than half your annual benefit because you decided to work. The kicker? Once you claim Social Security, that decision is permanent. You locked in a reduced benefit for life. Most people claim at 62 because they need the money now, which means they're guaranteeing themselves a smaller check forever. And if they try to supplement that check with work, the government punishes them. The system is designed to keep you dependent on that one income stream and only that income stream. Now let's talk about bucket 2, cost reduction. This is where people get really excited because it feels like free money. Medicare premiums, prescription drug discounts, property tax exemptions, senior discounts at the grocery store, all of it. Sounds great. Let me tell you a story. There's a guy I know, ran a successful contracting business his whole life, sold it when he was 64 for $1.2 million. Good for him. He's smart. He put most of it in index funds. He's pulling about 4% a year. That's $48,000 in investment income. Plus, he's got Social Security, another $24,000. His total income is $72,000. Not rich, but comfortable. Here's what happened. His Medicare Part B premium, which is the one that covers doctor visits, got hit with an income-related monthly adjustment amount, IRMAA. Because his income 2 years ago when he sold the business was over $174,000, his Medicare premium went from $174.70 a month to $594 a month. That's $7,128 a year instead of $2,096.60. He's paying an extra $5,000 in Medicare premiums because he had one good year. And it's based on income from 2 years ago. So even though his income is lower now, he's stuck with the higher premium until the IRS catches up. But here's where it gets really interesting. Remember those property tax exemptions I mentioned? Most states offer them. In Florida, if you're 65 and older, you can get an extra exemption that saves you maybe $1,000 to $1,500 a year, depending on your home value. In Texas, it's similar. Sounds great, except these exemptions are means tested in a lot of places. If your income is too high, you don't qualify. So you've got seniors strategically keeping their income under the threshold to save $1,500 on property taxes, which means they're not doing Roth conversions, they're not realizing capital gains, they're not taking income from their retirement accounts beyond the minimum required, they're tax planning backwards. They're optimizing for $1,500 savings and ignoring a potential $50,000 opportunity in tax-free growth. The kicker here? The moment you optimize for cost reduction, you cap your income. You're playing defense instead of offense. And in wealth building, defense loses. Bucket 3 is where it gets truly insane. Tax optimization. This should be the most powerful bucket because this is where you actually keep your money. But the system is designed to force you to take income whether you need it or not. At age 73, you hit required minimum distributions, RMDs. The IRS makes you pull money out of your traditional IRA and 401k every year based on a formula. In 2026, if you've got $1 million in your IRA at age 73, you're required to withdraw about $36,500. That's taxable income. You might not need it, you might have other income, doesn't matter. The government wants its tax revenue. Now here's the really fun part. That forced income can push you into a higher tax bracket, trigger IRMAA surcharges on Medicare, make more of your Social Security taxable, and reduce or eliminate your eligibility for property tax exemptions or other state benefits. It's a cascade. One forced withdrawal creates 4 other problems. And if you don't take the RMD, the penalty is 50% of the amount you should have withdrawn. If you were supposed to take out $36,000 and you forgot, you owe $18,000 in penalties plus the regular income tax you already owed. It's the most punitive rule in the entire tax code. Let me tell you another story. I was talking to a guy at a conference, former engineer, 75 years old, sharp as hell. He retired at 60 with about $800,000 in his 401k. Didn't touch it for 13 years, just let it grow. Lived off his pension and Social Security. By the time he hit 73 and RMDs kicked in, his 401k had grown to about $1.4 million. His first RMD was $51,000. That income pushed him from the 12% federal tax bracket into the 22% bracket. It triggered IRMAA. It made 85% of his Social Security taxable instead of 50%. His effective marginal tax rate on that RMD was over 40% when you account for federal, state, and the cascade effects. He paid over $20,000 in taxes on money he didn't even need. And he's stuck doing this every year for the rest of his life, with the percentage he has to withdraw going up as he gets older. The kicker? If he'd done Roth conversions in his 60s, when his income was lower and he was in the 12% bracket, he could have moved that money over years, paid 12% tax, and had it grow tax-free forever. no RMDs on Roth IRAs. But nobody told him. His financial advisor didn't mention it. The system doesn't incentivize advisors to do multi-year tax planning because they get paid on assets under management, not on tax savings. So this guy, who did everything right, saved his whole life, let it grow, got screwed by the same system that's supposed to be giving him 28 amazing benefits. Now let's talk about the benefits that actually matter, because there are a few. They're just not the ones everyone talks about. Number one is the capital gains exemption on your primary residence. If you're 55 or older and you sell your home, you can exclude up to $250,000 in gains if you're single, $500,000 if you're married. That's tax-free money. This is enormous. Think about it. You bought a house in 1995 for $200,000. You sell it in 2026 for $800,000. That's $600,000 in gains. If you're married, the first $500,000 is tax-free. You pay long-term capital gains tax on the remaining $100,000. At the current rates, that's $15,000 in federal tax on a $600,000 gain. This is one of the few benefits in the tax code that actually rewards you for building wealth instead of punishing you. And it's not means tested. It doesn't matter if you make $50,000 a year or $5 million. The exclusion applies. Number two is Medicare, but only if you understand how to use it strategically. Standard Medicare is actually pretty good. Part A is free if you paid into the system. Part B costs you $174.70 a month for most people. Add a Part D prescription plan for maybe $30 a month and a Medigap plan to cover the gaps for another $150. And you've got comprehensive coverage for about $4,000 a year. That's way cheaper than private insurance if you're in your 60s and not yet eligible for Medicare. But here's the move nobody talks about. If you retire before 65, you're in this gap where you don't have employer insurance and you're not yet Medicare eligible. COBRA is insanely expensive, maybe $1,500 to $2,000 a month. ACA plans can be cheaper, but the premiums are based on income. So here's what smart people do. They retire at 62, they take Social Security to cover living expenses, they keep the reported income low by not taking large IRA withdrawals, and they qualify for subsidized ACA coverage that costs them maybe $200 a month instead of $1,500. Then at 65, they switch to Medicare. They're essentially using the ACA subsidy as a bridge. It's completely legal. It's using the system exactly as designed, but it requires planning. Number three, and this is the big one, is the 0% long-term capital gains bracket. If your taxable income is below $94,050 as a married couple in 2026, your long-term capital gains rate is 0%. Zero. This is absurd, and it's criminally underused. Here's how it works. Let's say you're retired. You're living on $50,000 a year from Social Security and a small pension. Your taxable income after deductions is maybe $30,000. That means you have $64,000 of room before you hit the top of the 0% bracket. You can sell $64,000 worth of stock, pay zero federal capital gains tax, and immediately buy it back. You just reset your cost basis. You harvested $64,000 in gains tax-free. Next year, you do it again. Over 10 years, that's $640,000 in gains you've realized without paying a dime in federal tax. This is how wealthy people transfer wealth across generations without the IRS taking a cut. But it requires you to keep your income low, which means you can't take big IRA withdrawals, which means you need to have money in taxable brokerage accounts, which means you need to have been saving outside your 401k your whole career. See the pattern? The benefits that actually build wealth require you to have wealth already and to have structured your finances in a specific way for decades. The benefits everyone talks about are designed for people who are broke and staying broke. Let me give you a concrete case study. Two guys, same age, both 65 in 2026. Guy A worked for a corporation, maxed out his 401k his whole career, retired with $1.5 million in his 401k, takes Social Security, gets $24,000 a year, takes his RMD when required, pays taxes on everything, and ends up with about $80,000 a year in after-tax income by the time he's 75. Guy B also worked for a corporation, but he split his savings. He put some in his 401k, but not the max. He put the rest in a taxable brokerage account. He retired at 65 with $800,000 in his 401k and $700,000 in his brokerage. He does Roth conversions from 65 to 72, moving money from the 401k to a Roth IRA while he's in the 12% bracket. He harvests capital gains in his brokerage account every year at 0%. By the time he's 75, he's got $400,000 in his traditional IRA, $900,000 in his Roth IRA, and $600,000 in his brokerage. His RMDs are small because his traditional IRA balance is smaller. Most of his money is growing tax-free in the Roth. He's pulling from the brokerage when he needs extra cash, paying zero on long-term gains. His after-tax income is also $80,000 a year, but he's paying $20,000 less in lifetime taxes. And when he dies, his kids inherit the Roth IRA tax-free. Guy A followed the conventional advice and got crushed by RMDs and the tax torpedo. Guy B thought like a systems designer and gamed the structure. Now let's address the elephant in the room. All of these benefits, all 28 of them, even the good ones, are designed with one assumption. You're going to spend down your assets and die broke. That's the model. The government wants you to convert your wealth into income, tax that income, spend that income, and leave nothing behind. Every benefit is structured to encourage this behavior. Social Security is an income stream that dies with you. Medicare is expense coverage that stops when you die. RMDs force you to liquidate your tax-deferred accounts. Even the property tax exemptions are designed to let you stay in your house, which is an illiquid asset. Instead of selling it and having liquid capital, you could invest. The entire system is built around consumption, not accumulation. And here's the really cynical part. The government calls these benefits. They market them as this generous social safety net. But look at the incentives. Social Security replaces about 40% of your pre-retirement income if you were a median earner. That's not enough to maintain your lifestyle, which means you're either downgrading your life or you save separately. Medicare has gaps, which is why you need Medigap insurance, which is private insurance that you pay for. The property tax exemptions save you $1,000 a year, while your actual property taxes go up 3% annually, so you're just slowing the bleed. These aren't benefits. They're subsidies to keep you in the middle class instead of falling into poverty. If you're trying to build generational wealth, if you're trying to leave something behind, if you're trying to fund your kid's down payment or your grandkids' education, the system is actively working against you. Okay, here's what you actually need to do. 3 moves. First, plan your retirement income in layers. Don't just pull from one source. You want some money in tax-deferred accounts like a traditional IRA, some in tax-free accounts like a Roth IRA, and some in taxable brokerage accounts. This gives you control. In a low-income year, you pull from the Roth and pay no tax. In a year where you need more, you pull from the brokerage and harvest gains at 0%. You only touch the traditional IRA when you have to. This is called tax diversification, and it's the single most important wealth-building move you can make in your 40s and 50s. Second, do Roth conversions in your 60s, before RMDs hit. This is a 7-year window from 65 to 72 where you control your income. You're not working, so your salary is gone. Social Security is your baseline. You convert money from your traditional IRA to your Roth IRA in chunks that keep you in the 12% bracket. You pay tax now at a low rate to avoid paying tax later at a high rate. This is the move that separates people who understand the system from people who just react to it. I've run the numbers 100 times. For someone with a decent IRA balance, this can save 6 figures in lifetime taxes. Third, ignore most of the 28 benefits. Seriously, the senior discount at Denny's, the reduced bus fare, the free checking account, it's all noise. It's designed to make you feel like you're winning while the actual money is being extracted somewhere else. What 99% of people do is chase small savings and miss massive opportunities. They clip coupons and ignore Roth conversions. They get excited about saving 10% at the movie theater and forget to harvest capital gains. They optimize for feeling smart instead of being rich. The senior benefit system isn't broken. It's working exactly as designed. It's just not designed for you. It's designed to manage a population, to keep tax revenue flowing, to prevent an epidemic of elderly poverty without actually making anyone wealthy. If you want to build wealth in your 60s and 70s, you have to ignore the marketing and focus on the three things that actually move the needle: tax structure, asset location, and long-term thinking. Everything else is just a distraction with a nice title.